one of the things that I love about One Rental at a Time is as we've grown, as we've collected relationships, we have really broadened our experience level. For example, one rental at a time, single family homes, duplexes, so on and so forth. But there's a whole nother side of the market. We've talked about commercial properties, we've talked about syndications, and one of our weekly experts who's been here for years and frankly called the pain that we are going to have that has already started and will continue, the one and only Jonathan Twomley. How you doing, sir?
I'm doing very well, Michael, and happy new year to you. Have not seen you yet in 2024, so happy new year and happy new year to everyone watching the video.
Yeah, thank you for that. Thank you for coming back. You definitely broaden out our experience level. You can talk in depth. You have bought big buildings. You have syndicated deals, and I wanted to rap about something that Grant Cardone is saying. Now, it may just be marketing spiel, but he is out there pretty regularly now, Jonathan, talking about the greatest wealth building opportunity in real estate is in front of us. He is talking specifically about the next couple of years. To be clear, he is saying not residential, not single family. He is talking about your world. He is talking about commercial, multifamily, and office. So somebody who's been doing this for over a decade and somebody that called the pain we're going through, do you think this might be the greatest opportunity to build wealth in your lifetime?
I don't know about greatest, but I do think it has the potential to be pretty good. Right? I do think it's certainly the best opportunity that we have seen since the great financial crisis.
Okay.
Whether it exceeds that or not, I really don't know. I mean, the great financial crisis was a pretty good time to be buying real estate. The I wonder if one of the reasons why Grant Cardone is saying this is because he, like many people, may have actually, in all the noise about single family houses at the great financial crisis, may have missed the fact that every other asset class also took an incredible beating at that time, including multifamily, including massive foreclosures in the multifamily business. But I think people just were not focused on it. And then there grew to be this mythology that, oh, apartments did fine during the great financial crisis, or office did okay, or whatever. None of this is true.
Yeah.
So
Yeah.
there was a great opportunity then as well. So whether this will exceed it, I don't know, but I certainly agree with him that the potential is there for a great opportunity. Now,
Yeah.
what could get in the way of this great opportunity? I think a lot of the stuff that you and I have been talking about over the last few months may kind of temper the opportunity. And what I mean by that is banks learned their lesson during the great financial crisis. And one of the things that they did badly was they just foreclosed on everything and then dumped it on the market. And they
Mhm.
caused a huge price correction as a result. That I think banks are going to try to manage better. I think it's going to
Yes.
be a much more managed process. I think most investors will not see things hitting the market. They're going to be, you know, some will go to a special servicer. They will go to brokers who are tasked with finding the right buyer quietly. You know, th- those people are known. It's not like uh, this process. The deep pockets are known, right? So
Mhm.
I think what you're gonna, and you'll see also a lot of, as we've talked about before, the sort of triaging of assets, right? So,
Mhm.
good assets with good operators that just happen to be in trouble because of the debt, well, they'll get their debt restructured, right? The banks will just restructure that debt to take the burden off, extend, maybe they're going to extend the payment periods out or adjust the interest rates or whatever, but they're not going to want to take those assets onto their balance sheet. The assets that are good assets with bad operators, well, the banks will replace the operators. And it's only the bad assets with bad operators that will actually go through the foreclosure process. And even then, I think a lot of that stuff will be they will try to be marketing that stuff quietly. And I don't think that you'll see this sort of mass wave of public foreclosures happening. That being said, I think at the smaller end of things, where you have, and this is the good news here is that this is all of us, right? A
Mhm.
lot of people, listening to this call right now, if you are thinking about stepping up from single family to multifamily, this may be a really good opportunity for you to do so. And I'm not talking about like making this jump from, owning single families to buying 200 units, right? That's syndicator
That's a
guru
bridge too far. Yeah.
course hype stuff, right?
Right.
What I'm
Right.
talking about uh is is buying your first 10 unit, right?
Exactly.
Or your first 20 unit, right?
Mhm.
And I think for a lot of that stuff is in on the balance sheets of local banks,
Yep.
right? And that's the kind of stuff that those banks are less sophisticated, and they're just going to wind up having to take some of that stuff back because some of those operators are weaker,
Mhm.
right? And so I think for that, there's going to be some really good opportunities. And for all of you listening out here, um, the the time is now to go start talking with the banks, getting to know
Mhm.
the REO officers at the banks. Just get to know them. Like, you don't need to go in there with a big song and dance or presentation. Just go in
Mhm.
there, get to know, take them out to coffee, get to know who they are, explain to them that, hey, I own 10, 20 single family houses, whatever it is already. I know what I'm doing. I'm,
Mhm.
ready to take on bigger assets. And, I just want to start this relationship with you so that when these things start coming, I want to be in a conversation. And
Right.
that I think is where the opportunity is going to be.
Yep.
Um, so yeah, greatest opportunity ever? I don't know. Greatest opportunity in a long time? Absolutely.
Yeah. I
Absolutely.
actually want to kind of break this down because I actually think for Grant, it probably is the best opportunity of his lifetime. And I say that because of really what you walked through, right? There's the good operators with bad debt, they're going to work it out. Then there's good assets with bad operators, they're going to replace the operator. That's where I think, again, one guy's opinion, Grant Cardone is probably on the list of 10 to 20 big operators. So I think he will likely get a phone call for some of those assets and be able to structure deals.
Right. He's deep pocketed, right?
Yeah.
He's got a lot of resources at his disposal. So he will be in that conversation for
Yeah, you
sure.
would think, right?
Yeah.
And then there's the bad assets that are bad operators that will ultimately be foreclosed and go out to market. Um, so I think for guys like Grant, there's, I don't know, 50 of them, 30 of them, whatever it is. They're going to be on some pretty short lists. They're going to get the opportunity for, solid assets. And we'll never see them. Little guys like us will never see them. And they'll be done quietly, to your point. So I don't think he's talking nonsense. I think there's a chance that he's right, by the letter of the law. But
Well,
to your
listen,
point, yep, go
yeah.
ahead.
No, go ahead. No, finish your thought now.
But to your point, what about the rest of us? And I'm so glad you went there because I've been telling people for 6 months, my intention, my focus the last couple of years was residential single family homes because what I saw coming, and you and I talked about this in 19 and 20, and it's a little more delayed than we both thought, is I wanted 1031 out of houses into distressed small multifamily, the 5 to 40 units. And the other thing that you said that was absolutely right was the Great Recession was known for single family homes. My market went down 75%. But what people don't remember, also in my book, was we picked up like 70 apartment units directly from small and regional banks about a year after we stopped buying houses,
Mm.
right? Wall Street came in, changed it overnight, but we still had these apartment buildings limping along, limping along. Like one of the buildings we picked up for 700 grand was marketed for $1.4 million for almost 3 years. The bank kept extending and pretending it, and finally had to foreclose. We bought it for 700 grand, no cash, no down payment. All we had to do was escrow 50 grand for repairs, which we would have spent anyway. And I think that's coming again. And they don't run in the same cycles, right? If we had distress last time in houses, apartments, they bleed longer, but the pain is there nonetheless. So I look forward to the opportunity. And man, if I can repeat what I did last time, sell 8 houses, buy 80 units via 1031, I'll be a happy camper because I own a heck of a lot more than 8 homes today.
Well, so here's, I mean, I think that's a great point, and I think that those kinds of opportunities are going to be out there. And the reason you had those opportunities is because you already had the relationships with the banks,
Bing,
right?
bing, bing. Yep.
So that's really the key. It is very hard. I mean, so when at the great financial crisis, I mean, I was getting into this business or sort of shortly after thereafter, and I was watching, I was aware of massive transactions going on where banks were selling, you probably remember this, like tapes, right?
Yeah.
Where people were buying, houses for $7,000 each, but the problem is you had to buy like 100
The
of them,
entire tape. Yeah. You had to buy
right?
the entire
And
tape. Yep.
so the thing was that you didn't get it. There was you weren't even allowed to bid on this stuff
Nope.
unless you
Yep.
were already like on the pre-vetted list. And
Correct.
so you could sort of sit there helplessly thinking like, oh my God, I wish I could somehow be part of
Mhm.
this, but you just couldn't be. So,
Yep.
and the reason is because, I didn't know how to go about getting access to
Mhm.
stuff like this. But you have the ability to do this now, right? You can go and
Yep.
start talking to the local banks in your area and say to them, hey, you know, what you got already, and if you don't have
Yeah.
anything, like let's just keep on talking and meet with them once a
Yeah.
month and
Yeah.
just because those REO officers are going to be like, they're going to have like nothing to do, nothing to do, nothing to do, nothing to do, nothing
Yeah.
to do, nothing to do, nothing to do, and suddenly they're going to have like, they're going to be
Bam.
so busy that
Yeah.
they're going to be like crying, right? So
Yeah.
um it's go talk to them now while they're still relatively, before the wave hits them,
Mhm.
and then get to know them. Now the thing I wanted to bring up, so to the point of Grant Cardone saying this is going to be the greatest opportunity, in his lifetime to buy commercial properties, something really interesting popped up on LinkedIn the other day, which was somebody posted a report from TREP, which is a data collection agency for
Hmm.
commercial property.
Okay.
They track loans, right? And this TREP data said that there were actually more distressed multifamily properties than office.
Ooh. Wow.
Yeah, I mean, and so obviously there was a lot of pushback on this. It can't be true, but it's like the data is the data. And I mean, think about this. It does actually make sense, right? First of all, multifamily is a bigger asset class. There's
Correct.
just more,
That's the key.
there's
Yes.
more
More of
of
them.
them than
Right.
office out there. But the other thing is that, the office distress was caused by the double whammy of work from
Yeah.
home and
Mhm.
then interest rates rising, right?
Yep.
But before those things hit, there was not a frenzy buying
Correct.
office buildings, right? There was
Yep.
not a bubble in office property and people going crazy and doing syndications and overpaying for properties and bragging about overpaying for property. I mean, office is still like a highly professionalized uh asset class where really only like the big sophisticated players are playing, right? And
Mhm.
they're going in at low leverage, right? And
Correct.
they're going in with really conservative underwriting, and it's all like insurance company money and hedge fund money, and it's just it's like the most conservative
Yeah.
money going into office, right? So they just got blindsided, but they were not going in there like overpaying for
Yeah.
office
They
properties.
were doing value add and burning out their capital and, doing all of this stuff. It was just
Yeah,
steady. Yep.
yeah, and flipping in and out of properties in
Yeah.
18 months and all this kind of stuff. But in multifamily, I mean, look what everybody did. They went and there were
Woo.
people bragging, including Mr. Cardone there, bragging about overpaying for property,
I
right?
remember.
And then, doing crazy debt structures and variable rate debt and all these
Mhm.
things just to try to make the deals work.
Yep.
Uh, and that is where the problem really is. So you've got all these 2021, 2022 vintage,
Yep.
debt loans out there with expiring rate caps and all kinds of other nonsense because people got
Got
into this.
stupid. They
They
just
got
got dumb.
stupid.
They
They
got
got
dumb.
stupid.
Yeah.
So it's not surprising to me at all that you actually have a potentially bigger problem in
Uh,
multifamily. The
I
combination of it being a bigger
totally
market
agree.
and there being more
Yeah.
stupidity. And here's the thing too. And I just want to remind people of this. I made this point before, but when you're thinking about investing, right? This is a little bit more of a meta thing, right? But you have to think about this. And Michael, you kind of talk about this a lot without talking about it, right? So
Mhm.
let's kind of bring it out. What happens with investing is that whatever asset class was relatively safe in the last crash, everybody will rush into it in the next
Correct.
cycle, and then they will make it more risky,
Unsafe. Yes.
right? Right. And this is the dynamic that happens all the time.
Yep.
So you see everybody, single family houses were supposed to be the safest thing in the world because
I
everybody's got to
remember.
live,
They
they've got to
never
live.
go down,
They
Jonathan. They
never,
only
they
go
never
up.
go, they never go down. And plus, like these securitization pools that, well, they can't all possibly fail at the same time, right?
I remember.
It's diversified, right? The quants had figured it out, and then they
Uh,
all took a beating, and then they looked around and they're like, oh, well, multifamily didn't do so bad, and everybody still needs a place to live,
yeah.
right? So even in a recession, they need a place to live. So everybody piled into multifamily, right? They believe that story about it being totally safe, about, could not go wrong. And
Mhm.
people are telling themselves a story about there's a housing crisis and there's a supply problem, and you'll always be filled and always be filled and all this sort of stuff. And then it's all true until it isn't true anymore, right? But the problem is that since everybody has the same thought and they all pile in, then they increase the risk inherent
Mhm.
in the market, right? It's like, I don't know if you
Yep.
remember back to like high school physics, but there's potential energy and there's the other one. Like actual, I forget what it is. The potential energy though is basically the higher you, because of gravity, the higher you
Mhm.
lift something, the more energy it has when you drop
Right.
it. Right? So it has more
Yep.
potential energy. Markets are just like that. The higher the market goes, the more potential energy it has to release in a crash, right? If
Mhm.
it doesn't go as high, it won't fall as far and as
Right.
fast, right? So
Yep.
and markets are the same way, and everybody piles in to whatever they perceived as being the safest the last time. And it's all that sort of like herd mentality, group think, everybody doing the same analysis and
This
coming
is
to the same
exactly
conclusion.
why I go to meetups, me
Yeah.
personally. I
Yeah.
love helping people, all of that, but I want to see where the masses are going. And then I get out of the way, right? You want to all be brand new syndicators in 2021? Great. I ain't touching that stuff.
Yeah.
Great. You want to go do Airbnb arbitrage? Great. I am not going there. Like everything that everybody's doing because it's easy, man, real estate's never easy. So I get out of the way.
Right. Well, so there's the one thing, it's easy. Now, I've also been talking a lot about this on LinkedIn too, but so people very often confuse easy time to buy with good time to buy and
Mhm.
hard time to buy with bad time to buy. As a
Correct.
matter of fact, it is the opposite, right?
Correct.
Hard time to buy is good time to buy. Easy time
Yes,
to buy is bad time to buy. Why?
exactly.
Because of this potential energy problem that I just talked about, right? You've already at the bottom of, after a crash, you've released all that potential energy. You're not going to crash more, right? Maybe you'll kind of bump along on the bottom for a while before the market starts lifting up again, but your risk is a lot lower at that point. It's a great
Correct.
time to buy. You know, it's at the top when everybody buys that you really have the most risk. And the problem is that most people's investment decision doesn't consist of doing analysis. It comes from licking their finger, sticking it in the air and seeing which way the wind is blowing, or looking around and seeing what everybody else is doing and doing the same thing because it must be safe. And then they go out and they come up with a bunch of data that supports why they should be doing the same thing as everybody else.
Mhm.
What you should be doing is looking around, seeing what everybody else is doing, and asking yourself, is this a good idea? Should I really be following this crowd or not? Is there something that they're overlooking? What are they not investing in right now? Like, what are they bypassing? What are they crapping on as being bad, right?
Yep.
Now, here's a good example of this. Everybody was rushing into the Sun Belt, right?
Yes.
People were poo-pooing the Midwest. Oh, in the Midwest, there's no population growth. Oh, the Midwest is this and that. It's the Rust Belt. Guess who's doing great now? All the people who bought in the Midwest are doing just fine at the
Yes.
moment, right? Because they avoided that siren song of like, oh, you got to go to Texas because of population growth, or all- so just, do your own analysis, right? and figure out where the missed opportunities are and figure out where other people are not going. But
Absolutely.
the greatest opportunity is when when you find something and you have to scratch your head because the question you're asking is, why is nobody investing in this? Like when you have that feeling of like, maybe I shouldn't because nobody else is,
Mm,
like, that's actually a signal to you that maybe you're onto something
yeah.
because it's overlooked, right? This is what I've discovered with this hotel business, right? Is that these assets that nobody wants to touch,
Mhm.
well, it's just because they're scared of touching
Yeah.
them, but they're and the because everybody's scared, it's great. I love it. I mean, people don't
Mm,
want to buy because they're afraid, which means bargains are, are
absolutely.
available. So
That's awesome. Well, Jonathan, thank you for doing this. You are our syndication, our multifamily expert. Thank you for coming back each week. I think there's a lot of opportunity ahead for the big boys like Grant. But more importantly, I think there's opportunity for folks that follow one rental at a time because there will be pain in these small 5 to 40 units. Where can people find you?
well, listen, if you want to actually learn how to buy these things, and like this is what I teach, right?
Yep,
So you don't have to, I do teach syndication, but that is not necessary to this process. It is
exactly.
just a way of getting the money to do it, but you do not have to syndicate deals. I teach you the rest of the process as well, about how to find the deals, how to get them done, how to get the financing, all of that sort of stuff. So please come, to Apartment Investors Club, get on my email list. We're going to be opening the program up again in the not too distant future. So if you want to get on the list and get ready, reach out to me. So just go to apartmentinvestorsclub.com. And you can also go to my Facebook group, Apartment Investors Club on Facebook.
Folks, go to the Facebook group. Let him know you came from one rental at a time. He's putting out amazing stuff, helping people move forward. And of course, he's here each Thursday. Jonathan, thank you so much.
Thank you, Michael.
All right.